We're talking about explaining history, major world historic events.
This is as much a wealth crisis as a debt crisis. It's a problem of wages as much as investment.
It's a debt crisis, but it's also very much a crisis of economic theory.
I think the income distribution was the initial step in the dynamic that drove the debt crisis.
It's horrifying. I mean, this is, you know, all the people that we trusted have turned out to be completely untrustworthy.
This crisis is a total failure of markets.
So it's not simple.
And of course, boosting economic activity is just a euphemism for trying to encourage the economy to borrow even more, creating a credit boom or a credit bubble. So we're in this crisis in large part because our central banks have, for the last 2 or 3 decades, encouraged us to borrow more and more and more, and eventually got us into this unsustainable state.
You ask an American, when was America most prosperous in the 20th century? Most Americans, outside of financiers and Wall Street, will tell you the 1950s. It's thought of as this time of perfection, this golden age America that has the least income inequality in our history. And I don't think that's a coincidence. Before the sort of World War II period, income inequality was very high.
The share of total American income going to just the top 1% peaked in 1929 at about 22%, which is an extraordinary figure.
And then as you go into World War II, income inequality falls from 1945 to 1970.
In the 1970s, the top 1% were getting only 9%. That was a huge fall.
And then in the 1970s, you start to see it rise again, accelerating in the 1980s.
There's been a big shift in the way income growth has occurred in the United States, certainly, but also in other countries as well, though not to the same degree. What we've seen is that unlike the 3 decades right after World War II, when incomes grew at about the same rate for everyone, starting in the early 70s roughly, income growth started accumulating only at the top.
Partly that can be explained by the credit boom or the credit
To really
bubble.
understand it, you have to go back to the 19... There was increasing inequality, but there was also increasing debt.
The US was developing great productive capacity in consumer goods industries, such as refrigerators, such as radios, such as automobiles.
And these were very expensive for the average worker at the time.
And so over the mid-20s to late 20s, there's an incredible explosion of installment credit in America. People could borrow to pay for all the new modern electric appliances.
And you had a rapid rise in credit in the economy, to the point at which we got too much credit, too much indebtedness, and then eventually the system collapsed.
So the 1920s can actually be seen as a kind of precursor of what happened in the 2000s. So you have a very pronounced U-shaped curve, just as we have seen happening with income distribution.
And that's because economic activity, profit growth, and credit creation are all intermittently. If the banks are more willing to lend, it becomes easier for companies or for households to spend because they can borrow money and they can then spend.
Sales dollars from satisfied customers once again flow back.
So as credit rises, corporate profits rise.
The remainder of the profit is paid out as dividends.
Well, who tends to own the shares in the corporates and the shares in the bank? Generally, it's the wealthier people that own the capital stock of an economy. So if profitability is being boosted, then there's a natural tendency to polarize wealth distribution within the economy as well. That's a symptom of a credit cycle.
So I created for the United States a home price index from 1890 to the present. When I corrected these for inflation, consumer price index inflation, to my surprise, there was no increase in home prices from 1890 to 1990. It was just the same. And then there was this huge bubble in the US starting in 2000. And that was the only one.
The banks were interested in maximizing transaction costs. One could understand, that's capitalism. That maximized their profits. But they were doing it at the expense of the poorest Americans. There were attempts to try to stop this. It was clear that it was predatory lending. But they fought back. They stopped the legislation that was moving forward to stop the predatory lending. I've seen this. I've seen the kind of lending patterns. I've seen what they've done to some of these poor people. And let me tell you, it is outrageous.
I was trying to figure out what in God's name to do, and that's when I called my friendly mortgage broker and started wailing about my problems. He said, "Look, I'll figure a way out of this," and indeed he did.
Oh, put him on.
The value of the house had gone up about 10% over those 2 years.
Yes, sir.
And we ended up boosting the amount we had borrowed another $50,000.
I thought you would.
The theory of the whole maneuver was if I borrow more against the house and pay off my credit cards, my credit scores automatically go up, even though the total volume of debt is exactly as high, maybe a little higher than it was before. And because I've got those higher credit scores, now I can get a slightly cheaper loan. Go figure. It makes no sense at all. You have to be pulling the wool over your eyes aggressively to believe this kind of stuff.
The reason why the money, this capital, gets allocated into consumer debt and gets allocated into mortgage debt is because it actually has a better return than investing it in businesses, than investing it in factories or things that make things. And it's this simple, banal calculation that's behind all of this. It's not some greedy Wall Street banker. Wall Street bankers and all capitalists are always greedy. That's the basis of our entire system. It's that the opportunities for investment are different than they used to be. And that $1 put into credit card debt or into mortgage debt makes you more than $1 put into a factory. It's wonderful, it turns out, that while incomes were falling, house prices were rising. As the housing assets grew and their wages remained stagnant, people would borrow money from their houses to make up the gap in their wages.
This fall in the share of the bottom 90% represents a transfer upwards of roughly $1.5 trillion each year to the top 1%. This enormous upwards redistribution of American income took place in a stable democracy, with governments that were promoting this upwards redistribution being re-elected time and time again.
We've masked a lack of income growth by the fact that people have been supporting their living standards with more debt.
So what they were doing is they now had all this equity in the properties. So a lot of people refinanced to get rid of that debt, to consolidate the debt.
We had, in 1 year alone, over $900 billion in what are called mortgage equity withdrawal, much of that money going into consumption.
So you have roughly $1.5 trillion a year going up and roughly $1 trillion a year coming down in the form of house equity refinancing.
Was the assumption that real estate values would always go up. And I think even a fourth grader would be able to tell you that's impossible. It can't happen. That's contrary to the laws of physics. It's contrary to history. And yet somehow everyone literally bought into that.
I think responsibility is a difficult feeling for people in the sense that most people's participation, other than a select few, which had very, very important jobs, probably head of the rating agencies, some chief regulators, a couple chief bankers, etc. Most of the other participants in the system, I think, kind of felt like cogs in the wheel of a much larger piece of machinery.
Financial crisis. They talk about the regulation of financial institutions. They talk about evil people lending money when they shouldn't, taking advantage of people, predatory lending. But I think all those things pale before the real crisis, which is the way in which capital moves in the economy and the way in which wage inequality has caused this capital to move so inefficiently in our economy.
What we are doing, in effect, is transferring money from people who would spend it to people who don't need all that money and don't spend it. Record bonuses, hundreds of people getting more than $1 million a year, even when the company makes a loss. So the problem is that when you have growing inequality, typically your level of consumption goes down. In the United States, we said to those whose income was not going anywhere, we said, don't worry, continue to spend, as if your income was going up. But the only way you do that is through debt. But that particular model has been broken.
We need to have capitalism work for us, not work us over. This is the real difference, right? We need to figure out a way to make profits create jobs, not for everybody, not profits create just some wealth for the very few. If that's the case, then capitalism will no longer work because people will not stand for it. And what's made capitalism great for the last 500 years is that it's actually created better standards of living for everyone. The capitalism in the last 30 years has decreased the standard of living for everyone except those at the very top.